What is going on, investors? My name is Emmanuel. In this video, I'm going to share with you two stocks that I think right now present incredible opportunity. I think these stocks have been hit quite significantly due to investor pessimism. And as Benjamin Graham says here, the intelligent investor is a realist who sells to optimists and buys from pessimists. So since there's a lot of pessimism in these two companies, I think this might present incredible buying opportunities for us. Okay, so before we dive into the stocks, please make sure you smash the like button. If you're new to the channel, hit the subscribe button and the notification bell to stay up to date with all of my latest video content. With that said, let's dive straight into the video. Okay, so first up, we have Alibaba. Ticker symbol is BABA. And when you want to talk about pessimism, this stock is suffering from a lot of pessimism right now. Year to date, as you can see, the stock is down. Okay, the stock is down 5.7% year to date. But if you look at its highest point year to date to where it is now, the stock is actually down 20.67%. Now, if you're not familiar as to why this decline actually occurred in the first place, of course, the general market did see a decline from mid-February down to May. So that was a factor. However, the main reason why Alibaba took a hit was down to the fine. Okay, so if you're not familiar with the situation, China fined Alibaba a record, I think it was 2 billion. Let me double check. Yeah, so they got fined 2.8 billion. Okay, after a probe determined that it had abused its market position for years. Okay, so when we take a look into the financials of Alibaba later in the video, you'll see that this $2.8 billion fine was pretty much just a smack on the wrist. It hardly affected this company whatsoever, but the news of this caused a lot of fear in the market, and as you can see from its peak, we're down 20.67%. So now we have a good idea of what caused the pessimism in this stock. Let's take a look at Alibaba as a business. All right, so let's take a look at the key statistics. So these stats are absolutely insane. Okay, so they have a forward PE of 18, okay, with a trailing PE of 25. Their price to sales, guys, price to sales is 0.81. Absolutely insane. Now take a look at their profitability, and this is what really impresses me about Alibaba. Their operating margins is running at 12.50%. So essentially, for every $100 that the company makes, they keep $12.50 as earnings. Now, if you compare this to the likes of Amazon, okay, Amazon's operating margins is worse. Amazon's operating margin is only 7.10%. So Alibaba is running at a much better operating margin in comparison to Amazon. But let's even get a bit closer to home. Let's take a look at JD.com. All right. JD.com, Alibaba's direct competitor, is only operating at a margin of 1.24%. So that kind of puts into perspective how incredible Alibaba's operating margin of 12.50% really is. Okay. And if you look at the revenue growth from a year-over-year perspective, you're looking at 40.72% year-over-year. Now, is this growth going to slow down? I don't see it. Because if you take a look at their compounded annual growth rates, okay, over 5 years, 47.96%. Mind blowing. Over 3 years, you're looking at 42.05%. And from a year-over-year perspective, 40%. So these guys are growing their top line by over 40%, and I just don't see this growth slowing down anytime soon, especially with more adoption of internet in emerging markets. Alibaba has a ton of growth ahead of it, and don't just take my word for it. Let's take a look at some of the top analysts and see what they are saying. So we're on TipRanked, and as you can see, the lowest price target for Alibaba right now is $270. That is amongst all analysts. Okay, so if you look at the 26 ratings on TipRank, 25 of them are calling this a buy, with one analyst calling this a hold. Okay, and like I said, the lowest price target is $270. The average price target is $301.60, and then the highest price target that you have here is $350 a share. So that represents a significant amount of upside for us shareholders if these analysts are correct. So let's take a look at it from where we are trading currently right now. So pre-market, we're up at $217. So let's say from $217 to the lowest analyst price target, which was $270. So that represents an upside of what? You're looking at 24%. Okay, $301 was the average. So if we go up to $301, let's take a look. So we're sitting on 39, let's call it 40% return on our money, which is incredible. And let's be conservative and say maybe the average price target is a realistic one. So what does that represent for us shareholders now? So what, $301, you're looking at about 40, let's call it a 40% return on your money. that is not too bad. That is not too bad. And one thing that even gives me all the more confidence in Alibaba is Charlie Munger. Okay, so Charlie Munger's Daily Journal, they've been buying Alibaba. So they had the recent, they filed the recent 13F. And let's go down here. You can see, so the journal's new holding. Okay, so the company that the Daily Journal acquired shares of was Alibaba. At the end of March, the holding company reported 165,320 shares in Chinese tech company, giving it a 19% portfolio weight. The position was worth around $37.5 million. So talk about betting big on your best ideas. Alibaba right now weighs 19% of the Daily Journal's portfolio, which Charlie Munger runs. So this was when it was filed, so the end of March, right? But let's look at where the price was at the end of March. So let's zoom in a bit closer. So towards the end of March where it was filed, it was about $227. So we are actually getting a much better deal than when Charlie Munger was buying it, because we will be buying much cheaper than Charlie Munger at $217. So I think this represents a considerable amount of upside. You've got all the top analysts, they are calling this a buy. I mean, 25 out of 26 analysts said this was a buy. Charlie Munger has been buying, and it's extremely hard to ignore. So Alibaba is the first stock that you need to have on your watch list. I am very tempted. I will say that. I am very tempted. So next up, we have Beyond Meat. Ticker symbol is BYND. Now, I am bullish. Most of you guys already know me. Tattooed Chef is one of my largest holdings. So I'm very bullish on the plant-based food industry as a whole. And who are one of the trailblazers? Beyond Meat. They are one of the trailblazers. They've got great connections. And I actually had an interview with Jesse from Plant Stock. He actually enlightened me to who Beyond Meat are actually in partnership with. And I said I'm going to start doing my research. And I have been doing my research. And this company is pretty much amazing. The stock is amazing, but the stock is very rich. Okay, so for all of the connections that they have with McDonald's, with Pizza Hut, it does reflect in the market cap, because they are trading right now with a market cap of $9.29 billion, which is incredibly expensive, considering there are better deals like Tattooed Chef, which is trading considerably a lot lower than Beyond Meat. Price to sales as well is very, very rich. It's 22.25. So again, it's very expensive. There's no forward PE because the company is not yet profitable. Operating margins as well is pretty bad, saying at minus 13.85. Profit margins as well down by minus 19.58%. But take nothing away from the company, they did suffer a huge setback due to the Roni, and a lot of restaurants that they're working with, like McDonald's, have been closed essentially. So now things are starting to open back up. This represents a potential opportunity for us, but I do think it's still trading quite rich right now. Now, if you look at the balance sheet is okay. The balance sheet is all right, with total cash of 1.13 billion and total debt of 1.14 billion. So this is an okay balance sheet. It's not the strongest balance sheet by a long shot, but they do have a great current ratio of 18.12, which essentially means that the total current assets far outweighs the total current liabilities, which is exactly what you want to see in any business. And they are negative free cash flow, so not the best from a valuation perspective. One of the reasons why they're now back on my watch list is because there was some news that came out yesterday with regards to their partnership with Dunkin' Donuts. So the headline was Beyond Meat slides on report Dunkin' Donuts pulled Beyond Sausage Sandwich from the menu. Okay, and this was reported by JP Morgan, that says that it has confirmed that Dunkin' Donuts pulled the Beyond Sausage Breakfast Sandwich off its US menu and no longer has it listed with the food items posted on the company's website. So this is what came out yesterday from JP Morgan. It was reported on Seeking Alpha. However, there's been a statement from Dunkin' Donuts themselves. They've come out and said, look, we maintain a strong relationship with Beyond Meat and will continue to work together to explore innovative plant-based options to meet consumer demand for plant-based menu items. So they pretty much came out and rubbished the previous JP Morgan report, but nevertheless, the stock was affected. Now, as you can see in pre-market, it is down by 1.93%, but I need this lower. Okay, I do like the business, I do like the industry that it's trading in, but I don't like the current valuations. If we take a look at the stock price, I mean, I'm using the Fibonacci retracement tool here. As you can see, the share price is currently in no man's land right now. Okay, it's been consolidating between resistance and support right now. But for me to get interested in this stock, I would need it to test this support level, and probably this support level not to hold, and for the share price to drop a little bit lower before I could consider a startup position. I am bullish on the company long term, I am bullish on the industry long term, but I'm not quite bullish on the valuations at the moment. So I would like this cheaper, and maybe if it drops below 130, I could get interested. If we can see it retrace to $114 a share, which is a lower level of support, then I would probably be starting a position. But right now, I'm not sure whether this JP Morgan report with Dunkin' Donuts might be enough to push the share price lower. Like I said, it's only down 2%, and Dunkin' Donuts has come out recently and rubbished the reports. But it remains to be seen, okay? But definitely have Beyond Meat on your watch list. So that's all I have for you in this video today. What stocks are you looking at right now? Comment in the section below. I try and respond to as many comments as I can. Thank you so much for watching, and I'll catch you in the next one. Peace.